It's going to be the first series of a long series of masterclasses, and I think we couldn't have started with a better guest. So thank you, Doug. We're honored. It's the least I could say to have you here.
Well, thank you for having me. It's always a thrill for me to be in front of young founders dreaming to build a great future for themselves, for their companies, for their employees.
Nice. And we're here at Sequoia Capital. I will say when we pulled up on Sand Hill Road, it does something, right? You hear so many stories where dreams are made and broken right here. So it's a thrill to be here, and we're going to get started very soon. And before we do, I just wanted to do some boring housekeeping, but we'll conduct this masterclass. Of course, we have questions ready, but we also want to hear from all the founders that are connected and live right now. You have a chat system on your right where you can type, and we would love to hear your questions for Doug. And in the last 15 minutes that we have together, I'll make sure I'm reading out those questions, and it's your opportunity to ask Doug a question, hopefully relevant to the theme that we're going to cover today, which is how to develop successful founder traits and a successful startup culture. I see everyone saying hi and the chat's going crazy. Don't forget to also ask actual questions. And before I do get started with our questions, I did want to give a formal introduction, although, as David Letterman would say, our next guest needs no introduction, but we're here with Doug Leone. Doug is, I would say, widely recognized as one of the most influential venture capitalists in Silicon Valley. He's been senior steward of Sequoia until last year when he stepped down just to make way for new generations of leaders, but remains very active at the firm. As the leader of Sequoia, Doug has been influential in finding influential successful founders, mentoring them through the process. He's behind the success of companies like Nubank, RingCentral, and ServiceNow. He has a wealth of experience in identifying and nurturing the most promising startups. And we're also very proud to say that Doug is an Italian MVC. He emigrated to the US from Italy when he was 11. And you often talk about how that impacted you and how being an outsider blending in really forged your character. And I hope we can talk about that a little bit and about your story. But we'll start with the very topical and boring question, starting from the very top, which is, you clearly sat across from many founders, and you've previously said, this is no secret if you read a lot of the literature that talks about Doug and his views, you've previously said that the sort of traits that you look into founders are passion, resilience, resourcefulness, authenticity, and focus. And you also speak about spiky founders a lot. And so I just wanted to ask you if you could explain these qualities to us, especially spiky, because I think it's maybe one that Italian speakers particularly, but everyone might not fully understand from the get-go. And the other question that I really wanted to ask is, do you think these personality traits are inherent to a person, or can they be developed? Sorry, there's a lot of talk.
There's lots there. So what does spiky mean? Spiky means pointy, means taller than everything else, meaning that the founders we like to back have to be extraordinary in one or more ways. Let me give you some examples. Some of them are brilliant programmers. They're 1% programmers. Some of them are crazy driven for different reasons. Maybe daddy didn't tell them they loved them enough, or mommy didn't tell them they loved them enough. Or sometimes, as we've seen, simple, silly things like competition with a twin brother creates spikiness. Often it's having been an outsider most of their lives. In some cases, having been shunned puts an engine behind them, the type of engine that really never goes away. In fact, the Sequoia partners we have, and myself included, has some of those traits. It doesn't always come from a pleasant upbringing. Sometimes it comes from a difficult upbringing. And, you know, the characteristic of founders, whether they're made or born with, as my partner Shailendra says, there are many roads to heaven, meaning they come in different ways. I have met people that are competitive, ultra competitive for genetic reasons. They were born that way. And I have people that are competitive for other reasons, that something the environment has done to them or with them. And so I don't really care where it comes from. I do care when we see it. Now, I have spent my career investing mainly in B2B. I've done some B2C. In B2B founders, I tend to look for a deep understanding of the problem. My first question is, how did you get that insight? It's usually, it doesn't come from two people getting in a conference rooms and say, hey, I've got a better idea to build a faster this. In B2C, at least for the last 15, 20 years, it's been more a revolution. It's an idea of a product, whether it be as a social network or a financial systems, but it comes from a clearly stated thesis. And so in B2C, I tend to look at the thesis. Why do you think this will hold? And so for different reasons, we back the different kind of founders. And one thing that really encompasses all founders is clarity of thought. Clarity of thought shows up in clarity of description. And so a founder that can articulate how they got the insight, what they're going to build, why it's better, how to maneuver a couple of steps forward, not 5 years down the road. When we hear one of those, we're likely to write a check.
And you talked about competitiveness and this idea of spikiness being something that you get from your upbringing or that you can maybe build through the work that you're doing because it's you against the world with your idea. So I guess it comes, as you said, in different forms. But do you think aggressiveness is part of that? When you say competitive, what specific do you look at? Do you look at someone who's loud and combative, or does it come in? How does it come up, and how do you see it when you sit across from someone?
I think aggressiveness is the last layer of conviction. I don't really care if you're aggressive or not. I do care you have conviction. I do care you have the determination. Whether the last layer shows up in quiet confidence, a subtle way to approach things, or being out there, it doesn't really matter to me. Now, if you're over the top in some ways, and I don't think you are, if you're very aggressive, and and I think you're obnoxious or will be rejected by recruits, obviously that's a problem. But I look for the depth of strength of character more than I look for the last layer.
That makes sense. And when you're in that pitch meeting or the subsequent meetings after you meet the founder, do you look for someone that you can mentor, or in another way of asking this, like, do you look for a rough diamond or a polished diamond? How do you see your role as Doug Leone, but also Sequoia, once you find that person you think has potential?
Great founders come in different flavors. The very first thing I'd say to all you founders, all these adjectives that many investors throw at founders, they're irreverent, they don't listen, they're a pain in the ass. Those, in my book, they're terrific traits. Because the last thing you want is a founder that listens to the last person to whom they've spoken. So I love irreverence. I love stubbornness, because conviction yields to stubbornness. Now, if within that you can find someone that can spot knowledge and listen and at least consider a point of view, and then decide that's a stupid idea or that's a great idea, that is the jackpot. And so, but the point is, remember those adjectives and wear them as trophies, wear them as medals, because those are the great adjectives that will get you through the tough times.
And you touch on something that is pretty basic, but I guess one of the biggest things that founders need to deal with, especially at the beginning of when they're kickstarting their idea and at the beginning of the road, which is how much do you stay convinced in your idea and the idea that you think you're doing the right thing? Because often, maybe, hopefully, you're disrupting an industry, and so you just cannot follow what others are doing because that's the place that you're in. But still be nimble and open to feedback And I guess the answer is depends of who's giving the feedback and what the feedback looks like. But do you have a rule of thumb or something
No,
that you?
there are no easy answers to the question you've asked. There are companies that try for 3 or 4 years to build a product. The market keeps on talking, saying no, 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 and those companies go away. And then you come across a company like Nvidia, worth, I don't know, $120 billion. I'm not too far off. Where if you look at the stock chart, or if you know the history, it was in some ways a failed graphics chips company that listened to signals on the market and shifted into AI. So there's no straight line road. To me, is when the market speaks after a few years and it tells you I'm not interested in what you're doing. That's probably a signal founders ought to listen to. Now, founders are terrific at doing one thing that no investor can do, and that is finding product market fit, PMF. To me, that is the black magic. I wish I knew how to do that. We at Sequoia can help you build a business. And I will tell you, I think we're the very best in the world at that. But unless there's this product market fit, either from a rough diamond, a polished diamond, whatever you want to call them, it doesn't matter. We can't build a company where there's no product market fit. And so that is an essential, it's the core of the company. Product is the core, product market fit is the jewel, is the crown jewel. And if you have that, we can help you to build a business. That's what terrific, I wouldn't call them investors, business partners can do with founders.
And I've heard you say that a lot, this idea of how important product market fit is. So if there's one thing I think that one can take away is that's really the focus. I think that's right. What founders need to focus on for the first part, or actually for a long time when they're there. And when they come to a VC fund like Sequoia with that product market fit, as you were saying, you can take them to the next level.
Or maybe no product market fit, a description, well, the product market fit. We write checks as little as $100,000 to a simple, broad idea, and we'll help you to develop it. But at the end of the day, if you don't have product market fit, then you have no company. So then you're wasting time.
Clear. And let's go back to the more sort of soft skills and like personality traits that we really wanted to cover here, because I think that's something that a lot of people wonder, like, do I have it? Like, do I have what it takes to be a successful founder? And we were talking about the fact that there's no, no one road to heaven, and everyone can get there in different ways. Do you think, though, there could be a little bit of selection bias towards people that appear in a certain way? I want to go back to that idea of competitive and aggressiveness. And I know you said that's just the last layer, but I guess the idea is that you can't fake it, right? So nobody can prepare for a pitch with Sequoia and say, I'm going to come out with all the things that I think Doug wants. Like, you can see through that.
Yeah, look, we ask why questions. I want to build this product. Why do you want to build that product? This product is a winner. Why is it a winner? How is it different? I mean, when you say faking it, of course there's no faking it. You ask a couple of why questions and it breaks if someone fakes it. But I can't remember ever finding a fake. I may have met with people that I thought that were chasing very small markets or didn't think I had competitive type of differentiation, but no one, I can tell you, no one was faking it. They thought, in all cases, as they should, they had the best idea since the beginning of time.
Yeah, that's what we hope everyone comes in with. And you said this too, that one important part is recruits, and more than recruits, then also being a good leader. You're the founder of a company. You need to bring great people on board. And you need to take them through this crazy roller coaster that is building a company with you. So you need to have not only what it takes to have a great idea, but also what it takes to bring other people along. How do people successfully do that? Do you think there's some sort of recipe, or at least some tenets that people can follow?
So one of the things founders are not very good at is storytelling. And unfortunately, I think storytelling is what gets you to fundraise, and storytelling is what allows you to recruit someone, because you're basically asking someone someone who has a job, maybe has a spouse and children and needs money, to leave the security and join your dream. And early on, that's all it is. It's a dream. And so we have a group here at Sequoia that works with founders on storytelling. And it's really subtle and it's really valuable. And it starts with, can you describe your dream, your company in 2 to 3 words? Because everybody can describe it in 20 minutes, but can you do it in 2 to 3 words? Then can you do it in 30 seconds? Can you do it in a minute? As you know, most people's attention span wanes after a minute. And so if you can't get somebody excited in the first minute, you have a problem. And so one of the things founders are not terrific at, many founders, is storytelling. And I cannot encourage you enough as you start your company to be able to pass the 15-second test, the 60-second test, the 3-minute test, and then the thing that we know you're good at, the 10-minute test.
And I guess continue to do that along the life of the company. So adapt that story as you go and take people along by sharing your vision, not just on day 1, but on day 100 as well, so that people know what they're rowing towards.
Yeah, share your vision with clarity. Remember, always ask yourself the why. In other words, don't just tell them what you're doing, tell them why you're doing it. The same thing when you come to present to us. Don't tell us your thing can vibrate 1,000,000 times a second. So what? A great question that Don Valentine taught me to ask is, so what? That you can do this. So what? What does this mean in the context of the business you want to pursue? And so what is the same thing as why. And it helps you understand that a company is a symphony where you've got products, you have markets, you have marketing, sales, you've got competitors, competitive forces, and understanding how that all works. As a founder, I know you're going to be focused on product early on, but as you develop, to get the complete 360 picture of all that is key to building a great company.
And let's talk about, we're talking about this already, but the idea of vision. And unfortunately, they're not a lot. And I think by not a lot, there are almost no Italian unicorns. But there are Italian founders at the helm of unicorns. And I know a big reason, and I don't want to discount that in any way, is because of the ecosystem being just less mature and the market being smaller. But I often wonder whether it's also, and not just me, I hear it a lot when we talk to founders and investors in Italy, that there's a bit of a lack of a dream big mentality. This idea that was born here, actually, on this road, that you need to dream the next billion-dollar company. What would you say to that, and what mindset should a founder have on day 1 to really be able to make it?
I don't think it's because of dream big. In fact, most companies that become large, the dreams of the founders, the actual success of the company far outpaced the dream of the founders. When they work, they surprise all of us. I think one of the reasons, I think great companies come from 2 places. Either great universities, research labs that are a little bit more mercantile in the work they do, not advanced, the astrophysics where we're not going to get a company out of it, and from companies that set up R&D centers from which founders can then come. I remember back in India, until the great internet companies set up R&D shops, you were getting software engineers, but no one knew how to build products. In Israel, on the other hand, people built companies, but they would sell them too early, maybe a little bit of the dream big. Italy has, I think, wonderful schools, not a lot of R&D centers. Unfortunately, it doesn't have a government that cooperates with what young people do. And oftentimes it breaks my heart. We see people like you and I that ran away from Italy. Now, hopefully things are changing. I hope everybody doesn't run away from Italy. I know we have some R&D centers in Naples and Turin, I believe, and I hope that we see more. But those are the ingredients we need. It is not capital. Capital follows the smart people. Capital is the tail of the dog. The head of the dog is founders who know how to build products.
And you're right to say, I think Italy does have incredible universities, including the Politecnico of Torino, of Milano, and I know a lot of people will probably come from those universities. But then what's
And
lacking
Genova,
is
and Genova. Let's not forget Genova.
And Genova and Naples, and there's so many cities with great universities. But as you were saying, hopefully the next focus is not just having great engineers, but having engineers that can use their skills commercially to build a company. And we're not yet seeing that support system around.
Yeah, and build a company that is a Western company. What I mean by that is realize that you're operating within the European and American ecosystem. So the company you build has to be a differentiated company from what we see. In some cases, maybe you could have a local accounting company that serves Europe. There's a lot of small businesses in Germany, blah, blah, blah. Yes, that you can have some of those. But many companies, you've got to be aware of what's going on in the US and the greater Europe, because you're going to be competing in that market.
And that's another mistake not to be made, that you're not building a company for Italy and for your Italian users because they're limited, but dream to conquer the US and the entire continent, and
or learn what the other companies are doing. You cannot build a company for Italy only, although you could launch a company in Italy. That's called a beachhead market. As long as the beachhead market is aligned and in line with the rest of Europe and what's going on in the United States, because that's your large market opportunity.
And so I guess this is a hard question because it really depends, but if you were in the shoes of the people who are listening to us, i.e. an Italy-based startup, what would you like, and having the hindrance of being in less mature, smaller market, how would you set up your idea and how would you think about expansion?
Well, I'd first use my keyboard and my screen to figure out what the world looks like for the category or product I'm trying to build. Make sure I built a differentiated product for certain reasons. You don't need to have a vision for the end game. Oftentimes, we find that these very thin software layers that look like utilities, get a couple of customers, iterate and learn. And if you are aware of what's going on in the market, and if you get a handful of customers, I don't care if they're in Italy, I have to believe Italian corporations don't look too different than corporations in the UK or in the US. Just get in there, sell a few customers, get the customer feedback, and build this, what I call a utility, eventually into a platform. Because there's no way that you can launch a platform from day one and expand through this customer interaction, whether it be more in Italy or in other countries. Clearly, if you've got 10 customers in Italy, it's better to get customer 11, 12, and 13 in Germany, London than in Italy, because at some point you want to build the muscle of being international. And then at the right time, go overseas.
And so as I was telling Doug, Ines Mackwell and I co-host a podcast called Made It Podcast. And at the end, we always ask the same question. And our hope with that question is to just glean a little bit of the Italian competitive advantage of what Italian gives you. And hopefully there are things that not only helps you be, a good friend, but also a great founder. And the way we ask the question is, how do you think your Italianità or your Italianness contributed to your success? And some of the things that we hear are, ability to problem solve because there's so many obstacles to success, and ability to bend the rules because there's so many rules, so much red tape that blocks you, but also an eye to beauty and design that comes through even when you're thinking about how to develop code and being a software engineer and being able to create strong bonds and click and connect with people. And I wanted to ask you personally if you recognize any of these characteristics in yourself, and if you think you being Italian gave you sort of a leg up.
So I don't know if it's a quality trait, but I am very direct. I think of Italians as being very direct, where Americans don't get to the point, or they use flowery language to describe something. They feel very uncomfortable with a straightforward sí or no. They like to hear lots of words. And so to me, That's the number one advantage. The fact you can, as an Italian, and keep in mind, it's my impression of what an Italian is. I was Italian. I'm less Italian now, but maybe you can confirm this. Italians tend to be more direct. I remember my wife. She would used to ask me why I'm arguing with my mother, and we weren't arguing. We're just talking, and we were to the point. And we weren't arguing. We were just talking, and just the ability to tell it like it is, I think it's worth a lot. Then you can add all the design thing, because I do believe Italians are sensitive to all that. And look, if you make it in Italy, you have overcome you've become a lot of challenges. Think if you're in Silicon Valley, all you do is drive through Sand Hill Road, you have a half-baked idea, chances are someone's going to fund you. Think how easy that is. You have a Darwinistic opportunity to climb and self-select and make it from that environment. I think you're head and shoulder over somebody else.
Great. Well, those are inspirational words, and I will say I do agree. I don't know about the direct, but I will agree 100% on the tell it how it is. Like this ability to just tell people how you feel and not having to sugarcoat or hide. That was my big challenge in the UK. I'm like, people don't. Before I get through to someone, it takes a year, and I'm still not through. And in Italy, within the time of a chat, you already have a.
Or here in California, they tell, oh, give it to me straight. Let me tell you, if you come to California, Californians don't want to hear it straight. Maybe in New York, they're a little more straight, but in California, they don't like it straight. So I've had to get used to California and vice versa. California had to get used to me.
And before, I'm seeing stirred questions come through, and I want to give the opportunity to everyone to ask questions. But before we do that, I did want to go through a round of rapid fire questions.
Yes.
I hope you won't hate it. But just first thing that comes to mind, and I'll read through quickly. What industry do you see as the most promising for future growth?
I'm going to give you a boring answer. I think what has happened in the last 120 days with Chat GPT 3.5 and 4 is as big of a platform ship as the internet was, as the iPhone was. So think of 1995, Netscape goes public, bam, the internet is here. 2006, the iPhone. I think we can say the same thing about 2023 and AI. I think we'll probably achieve AGI within the next 12 to 18 months, and the whole world is going to be turned upside down.
What is the most common mistake you see entrepreneurs make when pitching VCs?
We see a lot. We see two founders, one is CEO and one is president, which means they haven't had the conversation. We see talking about a product, but not talking about the context of the product, as I said. We're buying shares, we're not buying the product. It doesn't mean that it has to be a presentation well formed, but why is this product important? Why will it dominate, not just what it does?
What's your proudest moment as a venture capitalist?
Probably 1999, when we woke up one day and we had a fund that was 0.3 of invested capital. I remember it was, it was a $300 million fund. After we fully invested, it was worth $100 million. And we went to work and we turned it into a 2X fund, which was a miracle at a time where all venture capitalists walked away from their 1999 funds. We refused to do that. Just on principle. And so that is the proudest moment in the Sequoia chapter, that in a Sequoia book that deserves a chapter.
Biggest professional regret?
Not dreaming enough with founders. I wish I dared to dream more. I wish, the mistake I made early on, and maybe now still, is that I lead my life through confinement, through parallel lines. I wish I threw away the lines and thought in 3D as opposed of thinking in 2D.
What's your favorite book on business or entrepreneurship, and one you recommend?
The Outliers, the story of 8 CEOs who build great companies and increase not market cap, because you can do that through acquisition, but dollars per share through creative thinking, decentralization of their companies, a low-key approach, not in-your-face approach, by a gentleman called, I think, William Thorndike.
Fondest childhood memory.
Oh, I remember I used to live in Genoa. I used to live in a street 1 block in from the port. I mean, it's the worst street in Europe called Via Pre. It's the worst of the worst. And we had no means to do anything. And we go down and play calcio where the goals were two panchines, not even opposite one another, but 90 degrees from one another. And you have to shoot under, and just going down and playing with my friends, having nothing, coming home dirty, have my mother look at me, how could you be so dirty? Those are the fondest type of memories.
Favorite, I don't know if I need to say, but Italian food?
Mandilli al pesto.
Ooh,
Because sono un Genovese.
Un vero Genovese, and I don't know if we have Genoveses in the
Yes.
Genovese in the audience, but great. Thanks for going through the rapid fire, man. It was really hard not to ask follow-up questions, but I needed to keep it quick. And I think we're ready for questions from the audience. So Virginia Pigaro from Plug and Play is asking, how did you build conviction as an investor? So this is from an investor perspective.
So the 30-second story is, I joined Sequoia at the beginning of one of many waves. And the wave early on was the software wave and the networking wave. And so the first 6 or 7 investments I made all had great exits, 3 IPOs, 4 sales. And I thought I knew, boy, I must be good at this. And then I woke up one day in 2000, I was on 12 boards, one worse than the other. All were going to be write-offs. And you go through what I call the abyss. You go through the shit, as we all go through in life. And if you're lucky enough to make it through the other side through toughness, you actually know a little something, and you build real self-confidence, not fake self-confidence like I did early on. And you start relaying your house brick by brick by brick by brick. And so you grow and you build conviction. But keep in mind, though, whatever conviction you have in our business and your business has to be written in pencil, number 2 pencil, because the world is changing at an accelerated pace. The moment you have conviction about something, the moment you think you know something, you're done. So the conviction you build, I build, we should all build, is how to break things down to first principles and then get to the right answer. So the experience shouldn't be there to give you the answer. The experience should give you the toolkit, but then you solve the next problem by breaking things down to first principles.
And I know it's not my place to ask more questions, but just to follow up on that, the first thing you said made me think of it. You often read and hear about the influence that Don Valentino had on you, and the idea of having how important are mentors, how important were mentors to you, and how important are mentors to build that conviction to follow someone?
They're accelerants. Now, a mentor has to fit the style. I was probably a non-guided missile, like when I joined here back in 1988. And I've told this story on another podcast. I came out of a meeting with Don Valentine, and I see a sheet of paper, a yellow paper, and Don wrote in green ink on yellow papers, and it said, Doug, not fit to listen to founders. And he left it there for me. And that was mentoring in his own way, i.e., you were too aggressive in your questioning, you were an asshole, and it's bad for you. Boy, that was an accelerant, an unpleasant accelerant, but an accelerant, I think. And that was done out of caring, out of love, not out of being mean. He just knew that I needed a 2x4 over my head. It doesn't work for everybody. It's what he understood I needed. So to find a mentor that understands what you need, is compatible with you, and can shake you up and speed you up, that is a blessing.
And I Italianized Don's last name
instead of
American Valentine, not Valentino. Instead of Americanized last names, I did the opposite in Latin. So forgive me for that. Okay, ready for next question. So from Gianluca Cocco is asking, when it comes to finding PMF, product market fit, before the seed, how important is it, I think is the question, to set the right unit economics versus growth rate and burn rate, given the new market environment with higher interest rates and VC winter?
So for many of you, we've come out of a world where cash was free, and it didn't matter if you burned a lot of cash as long as you grew, and it didn't matter if your revenue run rate was $300 million. Somehow things would magically converge with great unit economics sometime in the future, even if you have to raise $10 billion more. That was the world we came of. Now, people suddenly are saying, well, can you really make money on a incremental customer and so on? And so unit economics are more important, but in some cases, they're impossible to achieve in many ways in the very, very early days. There's no way that in the early days of Uber, if Uber was created right now, there's no way that you could have said, hey, I've got to be profitable on the first ride, because you never would have broken it into the market. I think the reality is now, though, is you have to be able to get to positive unit economics far faster than before. One, because the $10 billion that to fundraise or whatever amount of money that was available in 2020 is no longer available. Second, you don't have as many crazy competitors for you to compete. The next company that's raised $5 billion and they're doing some silly things. You have much more rational competition, a much more rational market. So what you need to be able to explain is that you can start a certain way, maybe unit economics negative, but shortly thereafter, and you define what shortly means, 6 months, a year, a couple of years, prior to raising $5 billion, that you can get there. And so clearly you want growth rate, because to have 3 customers with great unit economics means nothing. You clearly want many customers, but you've got to fine tune that balance of growth rate, unit economics, and raising far less capital than you were raising in the past.
And so would you say that this historical moment with the sort of characteristics that you just described is a opportunity for founders, or?
Well, I think it's a better time for founders, because earlier, no matter what you did, there was some fool willing to invest at whatever valuation you asked. So that was a crappy feedback type of mechanisms. In fact, there are many companies, maybe $50 million run rate, not growing, with 300 million in the bank, not knowing what to do with it, because people just invested. You don't have as many lookalike companies. You don't have to compete with Google, who was paying engineers close to $1 million when you can afford to pay them $180,000. And so it's a much more rational time to start a company. Fewer competitors, easier to recruit, people won't quit on you, and so on. So I think it's and a better feedback loop. I think it's a way healthier time for founders. I would prefer to participate in this market than the 2020 market, even though money was easy to be had, but money itself, that doesn't make a company. Right now, you have an opportunity to build a real foundation of a business. And if you have an idea that even halfway hums, there's plenty of capital out there.
Next question from Fabrizio Chiara, who's asking, how important is market traction in the early phase in fundraising, pre-seed, seed round?
No, it's seed. I mean, look, if you show up with 2 customers in a seed round, probably you're not going to want to raise a seed. You're going to want to raise something. I no longer know what seed is, actually, because I've seen $20 million seeds. But let's say it the following way. If it's the first capital, you don't need market traction. If you're lucky enough to have it, then you probably should move a little faster. And you probably have the semblance of product market fit. Why raise a seed round of $1 million? Do a little more, run a little faster. But in most seeds we do, there is no market traction. There is a spiky founder in a generally interesting area. That is our spec. I just gave it to you. A spiky founder in a generally interesting area that will get a seed check from Sequoia Capital.
Great. So I guess the other side of that advice is don't wait too long before you go try raise capital if you think your idea is worth being venture backed.
You want to do what's in the best interest of the company. The market moves, competitors move. Chances are that if you move very slowly in the early days, somebody will get to it before that you do. So,
All right, next question from Marco Galdaleta, who asks, if a startup has an excellent idea, validated with data, but without product market fit yet, because maybe the idea takes time and money to be developed, which approach do you recommend to follow, considering that not everyone has family and friends willing to invest?
That's what seed investing is for. I mean, the very best case is to have an idea and to be fortunate enough to find a long-term investment partner early on. One of the things we do find is companies that have done the family and friends round, they come to us and they've made a couple of critical errors. Maybe the two or three founders haven't had the right conversation among them of how much ownership they should each own. Maybe they think cash is free, so why don't we do a safe after another safe, then another safe? Money's being thrown our way, and by the time you do a real Series A, you lost half your company because you thought cash was free. We've seen this over and over again. And so if you're fortunate enough to find a strong partner early on, go for it. We have data that says, founders are always afraid of signaleness. What if Sequoia does the seed and not the Series A? We have data that says if Sequoia does the seed, your likelihood of getting a Series A from anybody, from us or somebody else, is far greater than if we're not in your seed. So find yourself a good business partner early on if you can.
Good early investors bring better chance of getting more investors down the line, I guess. I really love this question from Filippo Sergenti, who's asking a personal question and says, we're two 21-year-olds making language models as competent as a junior analyst. We just had a meeting with the biggest bank in Italy. Advice on how to close deals with enterprises being this young. And I will add before you respond, I do think this is one of the biggest challenges that Italy or the Italian mentality still has to break down, that being young is an advantage and not a disadvantage. But what's your reaction?
Yeah, I didn't understand what the youth had to do with it. To me, is understanding that you have something they need, price to value, and getting to someone who has money and not someone who just likes what you're doing. So if you're dealing with the banks, you want to solve a business solution. You want to, at least for yourself, build an ROI model from their standpoint. If I buy this company, if I buy this product, I can make more money or I can save them that amount of money. And then go in shamelessly ask for the order. To let them play with it for a limited amount of time, 30, 60 days, and after that, pay. When I was in sales, I remember we used to loan, some workstations. And when I was a sales manager, I used to tell the reps, get it out of there after 30 days or 60 days. And of course, the sales rep, if I do that, I'm going to lose the sale. No, we'll find out real quick if they really need it. And the same thing with you. Age has nothing to do with it. Of course, it does as it relates to experience, what kind of sales experience you have, especially when you deal with bank where you're selling to major accounts. A bank is a major accounts. There's a lot of politics, and you've got to figure out how it all works, who has the money, who has to approve it, who has to do all that. Maybe find yourself someone that knows how to do that as one of your business partners, but age has nothing to do with it.
Giacomo Putignano is asking, do you prefer bootstrap startup with slower growth but profitable, or a startup with quick and big fundraising and skyrocketing growth, even if not profitable yet, I think?
As long as the unit economics makes some sense, I like skyrocketing growth. Because here's what it says. I'm going to give you $10. And you're going to give me $5 a year for the next, say, 5 years. And if that were to hold, I should be willing to give you as many $10 bills as I can find, which means I'm going to be wildly unprofitable early on, but I know I'm going to make it. And so what doesn't make sense is if we say, I'm going to give you $10, you're going to give me $7 back, which many companies are based on. That sounds ridiculous. But no, I will take growth because growth means more customer, more penetration, more feedback, quicker learning, as long as these unit economics are somewhat attractive. They can be crazy lousy. Then I would move a little more towards give us a fewer, yet a little more profitable type of customers.
Great. I think this might be I'm keeping an eye on time. I think we'll make this our last question from Gregory Sheeb, who asks, Mr. Leone, how and when did you identify that you are good and what you are good at and what you are not good at?
You know, the market kind of lets you know that. If you walk left and someone slaps you over the head with a baseball bat, that's a pretty good hit and you weren't that good at that. When you walk right and some good things happen, that's how just keep your eyes open. And as I always say, have Dumbo ears. But it's important that you take steps somewhere. If you sit on your ass, then you get no feedback. Put yourself out there, take the shot. Most of you are young. I can't see you. I'm going to assume that most of you are young. Take the shot, go there, figure out when you make mistakes, why you make mistakes. One of my favorite interview questions is, what have you always done well and what have you done poorly that you've learned how to do better, and how did you learn that? It's a self-awareness question. It's the question that you've asked. And also it starts with the assumption kind of early on that maybe you're not very good at a lot of things, and be humble about it and learn and build confidence through time, but never think you've arrived, because life is a journey. It's never a destination. I can tell you right now, I'm pretty good at a lot of things. I'm not very good at anything. And I'm certainly lousy on a whole bunch of things. And I hope to get better at everything over the next 5 years.
Great. And I think that was it from us. I'm sure there are more questions, but that's the time we have with Doug. And thank you, Doug. This, I'm sure, has been inspirational for many. It will become a podcast episode that you can re-listen, so you have access to this advice again. Doug slept 3 hours and he's here with us, so we owe him a big amount of gratitude for being here. And thanks especially, I would say, for giving back to, I guess, your home country. And we really value that. And we are so proud to have so many Italians everywhere doing great things, and to find you amongst one of these people.
Grazie mille a tutti voi.
Grazie a tutti.